Most people picture a bank as a secure vault where physical cash is stored and eventually lent out to someone else. Modern commercial banks act as dynamic credit creation engines. This shift from storage to active creation explains how modern economies expand and why they occasionally collapse. Approving a loan creates a new asset, the loan, and simultaneously credits the borrower's account with a brand new deposit. Commercial banks initiate this expansion themselves, acting independently of the quantity of reserves held by the central bank. Banks are constrained by their own profitability, the availability of creditworthy borrowers, and the baseline interest rates set by the central bank. Because banks are active generators of the money supply, overall economic expansion is directly tethered to the lending decisions of private institutions. Banks perform maturity transformation, turning short-term, liquid liabilities like checking deposits into long-term, illiquid assets like 30-year mortgages. This creates a dangerous gap. A bank is solvent if assets exceed liabilities, but only liquid if it has enough cash on hand for immediate withdrawals. If just 15% of depositors demand their cash at the exact same time, a perfectly solvent bank can fatally collapse. Fractional reserves and maturity transformation generate high profits during stable periods, while ensuring the banking system remains structurally fragile. To counter this inherent fragility, governments engineered a shield of confidence. Retail deposit insurance prevents panicked customers from pulling their cash. Regulators also enforce a liquidity coverage ratio. This rule requires banks to hold enough highly liquid assets to survive a short-term crisis. If contagion still spreads, the central bank steps in as the ultimate lender of last resort to provide emergency cash. Without this engineered regulatory shield, the entire credit creation engine would inevitably shake itself apart during severe periods of financial stress. Narrow banking offers an alternative that eliminates bank runs by requiring banks to hold only safe assets that perfectly back every deposit. However, this stability comes at a cost, heavily restricting credit creation and making loans scarce. Modern banking relies on a delicate equilibrium. It is a highly productive credit engine built on confidence, efficient in normal times, but vulnerable under stress. Society accepts the inherent risks of fractional reserve banking as the calculated price for continuous economic expansion.